Greetings from our team at Robare and Jones Wealth Management. My name is Jack Jones, the managing partner with our July monthly market update. First, we want to thank our value clients for the trust and confidence that they've placed in us. And we look forward to seeing you again soon, hopefully in the office for the most part, and at client events in the not too distant future. I hope everyone enjoyed their July 4th holiday. I thought this was an interesting fact to bring up that many of you may know, but on July 4th of 1826, both John Adams, our second president, and Thomas Jefferson both passed away on the same day. Interestingly, as you see on the right part of your screen, John Adams' dying words were, "Thomas Jefferson lives or survives," not knowing that Thomas Jefferson had died some 5 hours before. We're excited to announce that as of now, we're back open for in-person client meetings. We've missed seeing you in person, and we look forward to gathering both individually and at client events in the near future. So kind of where we are in markets at the midpoint of the year, one of the things that's interesting about this year compared to the last two is that you've seen a decoupling of stocks and bonds. So 2019 and 2020 were good years for both stocks and bonds as interest rates declined. We've seen a reversal of that while risk assets measured by the S&P 500 are largely up because interest rates have moved up from 1 to about 1.6 as we sit here today. Bonds are overall down. We are off to the 18th best stocks year for stocks going back to 1926. So 90 plus years, this is the 18th best start. What's interesting about that is if you look at the average on the years with the best starts and all years, they're basically the same. So basically this tells you that this doesn't predict necessarily the first half of the best 20 years going back to 1926 as to what they'll do for the remainder of the year. We did recently rebalance. I want to talk about that for a second. Advisory accounts just a few weeks ago. Stan updated you in a video there in terms of what themes we added or things we preferenced in this recent rebalance. We rebalanced for a number of different reasons, and at least quarterly or as market conditions warrant. We do that to get back to a targeted allocation and to adjust to apply themes that we think are opportunistic. Included in this rebalance was a favoring of a little bit more value compared to growth, and among other things, a shortening duration on the bond side of our allocation. So the jobs report was very good. 850,000 jobs added the month of June. So that's a very good number. Unemployment rates stayed just under 6%, so not much change there. Interestingly, that 343,000 of the 850,000 jobs were travel and leisure. So a strong indication that the reopening trade as it relates to jobs is well underway. There are still about 9 million job openings in the country. Again, the mismatch of unemployment rate at 6 and job openings of 9 million remains a thing to be followed. Whether that's an inducement to not work or schooling or other factors is not fully known at this point, but it's definitely worth keeping an eye on. Inflation is something that's being talked about, so we're going to unpack it a little bit here. Inflation, as you'll know from our prior commentary, is running at about 5% May to May. So that's a hot number. What's interesting about the disconnect is the 10-year Treasury is only trading at 1.6 and a 3-month CD is paying you almost nothing. So this gap between this number and this number is the largest since 1980. So that's very much a thing to watch. How transitory or permanent or both, and in fact, what could be in it with as it relates to inflation is very much a thing to be watched. A couple of interesting points about inflation. We mentioned this in a prior update. is on housing. So housing prices April to April grew by almost 15%. And yet, when you look at it from a calculation standpoint as it relates to CPI, it only contributed 2%. So that's a 12.6% difference. So this just gives you an indication as to housing price increase not making its way to inflation, because the inflation rate is determined by what's called owner's equivalent rent. Another adjustment that's frequently made to inflation is what's called quality enhancements. So for most of us, an increase of 40 to 47 is an 18% increase. But the way CPI is calculated, they do what's called the quality enhancement. So if this was a cable bill, as an example, if your channels went from 71 to 80, your cost per channel is 56 to 59, so only a 4% reported inflation. So again, this is just a couple of pieces of data regarding inflation, where the actual way that you experience inflation may be much different than the way CPI is calculated. This also gets to a point of savings rates remaining incredibly low. On $100,000, you're only making about $80 a year. You need to beat inflation, almost 4,000. So money that's sitting in money market accounts is now having a greater erosion of purchasing power due to inflation. And that brings us to kind of the next point, which is there's still over 4 trillion in money market accounts earning that very low rate that we just looked at. So again, we think likely, whether that's capital spending or spending on personal vacations or other things, or investing kind of up the investment stack in stocks or bonds, we think likely those money market assets start to be used in the second half of the year. And that's a positive thing for the economy and for financial markets. And just a couple of things that will remind you of is how normal intra-year declines are. We're in kind of a sanguine market as we sit here today, but on average, going back to 80, so we're looking at 40 plus years, there's an average intra-year decline of 14%. So a correction, which is defined as a 10% or more decline, is to be expected and could very well happen for a combination of reasons. So it's just a reminder that markets are quiet and calm at present, but that never lasts. So there are a lot of different reasons that are kind of below the surface where markets could, again, for a variety of reasons, go through a correction in the back half of the year. So with that in mind, we will close. We try to keep that brief and just add some color to the summary things that we know you're hearing a lot about. We wish you all very well. We look forward to gathering in person in the very near future. Thank you for the trust and confidence that you place in us. And if you have any questions or there's anything we can do to serve you, please let us know. Until we see you again, stay well and take care.